Good morning, traders and investors around the world. Welcome to this Wednesday edition of Pre-Market Prep with Stock Odds. Joel Elconin, joined by Rob Friesen here on, well, I guess a bullish morning here. How can I say that? I can say that because we're well off the pre-market low, which was 37.52, and we're well off the intraday low of 37.60.50. And we are 6 points, 5 points, 7 points away from the intraday high of 37.96. The buy the dippers are out there, folks. Crude, that's down 68 cents at 95.16. Gold up a buck 10 at 17.25.80. Silver, that's in the green now by a couple pennies at 18.98. Bitcoin, that's down 80 bucks at 19,235. And Ethereum futures, they're in the red by a buck 50 at 10.36. So stop the screen share here, and I'm going to bring in Rob, and I'm going to say, not paused, I want to stop it. And I'm going to say, Rob, I wanted to buy the dip this morning, but I was too cheap. I wanted to buy the near closer to the pre-market low. And you said, well, a lot of times the pre-market low is the low for the day, and we build on it. You're right. Gaps down though. So what do you think now, Rob?
Well,
Talk to us about trading gaps.
Actually, for sentiment, would it be better? Think of it like this. Let's say you had a pre-market low, and then you really built on it like this, and then you rolled all the way back down and you were sitting on the pre-market low as the market opened. Is that really what you want? Or do you want a higher low that you can see that there's an appetite to continue to buy, so that the pre-market low was the low and now we're higher before the open? I mean, not massively so, because then you can have a problem where there was just too much premium factored in after that pre-market low. But there's a sweet spot. I mean, with your experience, you can kind of read it that people really want it. But if you roll all the way back over and you're at the open and you're sitting right on the pre-market low,
it's a shot. Yeah. Well, the reason is because I had a number that I really liked that was about 10 points away from the pre-market low, and the volatility on this, it would have been a good risk reward ratio.
Yeah, you wanted that margin of safety to lean on something,
Yep.
But a lot of times, it's no different than the discussion on support and resistance. Let's say, for example, you have a number and then you go and test the number. But if you test the number again a third time, you know what I mean? Like, it's like where everyone finally gets the confidence, it's when it's likely to break. And this is just things of experience that you and I have discovered over the years, right?
Mm-hmm.
So your probabilities change based on the action that's actually occurring, right? So anyway, let's run through a couple things here. Screen 2. I'm just sharing my screen here. Just want to run through the currencies, because obviously you've had a number of things impacting it recently, and of course today with the CPI numbers. So the argument is that the Fed is going to be have to be merciless related to this inflation problem. And going back to 1981 with Volcker, dealing with the 70s inflation, which we're back to. This is 40-year inflation here upon us again, right? So going back to that, what did he do? I mean, he just massively raised rates, and he did put a stop to it. So that's what the markets are factoring in, is, are we going to have another repeat of that? Now, Volcker and Powell are very different in their, first of all, transparency and trying to ease into things and all that. So it's a very different environment. But the inflation numbers may force the Fed's hand. I mean, we see from Canada today. So let's just run through this. US dollar, this is on the daily, and then I'll flip back to the 5-minute. Euro, tanking. I mean, euro and US dollar at parity. Japanese yen, that thing's been sliding. Cable, British pound, Canadian dollar, Swiss franc. I mean, that's had quite a bit of volatility for such a stable currency recently, actually. Australia, New Zealand, commodities based countries similar to Canada. So let's run through the 5-minute here and see what the response was when the numbers hit. So again, US dollar jumped, it's eased back a little bit now, but why? Well, I think we might have to do, instead of 75, you might have to do a full percentage point. We're going to have to be more aggressive than the runway that was initially laid out for us. That's what the market's thinking. That's what the currency traders have to respond to. It doesn't get there on its own. It's not, Powell doesn't make this tick. That's currency traders have to say, we gotta factor this in. We gotta adjust here. So that's why you get these moves. Euro, I feel really bad for Europe, as I mentioned on the show the other day. It's they got a lot more issues than you think. Japanese yen. Now, Canada raised a full percentage point today. So
saw that, yeah.
This was the initial drop that happened because the US dollar moved higher, but then here's the surprise attack of the 1%, and that's the pop that the currency had on that. So again, it's not even performing as well as I would expect it. I think it's possibly because of all the forecasts about the Canadian economy being under pressure. It is commodity based country, and recession isn't so good for things like we've talked about copper. Let's look at how the metals are reacting here. You can see gold drop on that CPI. Look at copper's just like we mentioned, been in a downward slope, and that's factoring in more recession. So I guess today, would you say that the battle sort of swings over to the people that are saying hard recession or longer lasting, or more that we're in it already? I mean, that's kind of where the argument swings, right? So before it was like, oh, we're not going to get into recession. No, we'll be okay. We'll skirt it. But do you see what I'm saying? I mean, this round goes to the recession people, wouldn't you say?
Yeah, the recession and higher rates. But
okay, to our topic.
Let's go. Let's
to our topic of gaps, okay? Because I know you got limited time. Market gapping is a wonderful thing for trading, right? It's not always convenient. It doesn't always feel, like you're enthusiastic about it. You're going to find that there's an element of fear, unknown, just like this morning with your debating whether to get in, or are we waiting for your number. I mean, there's a certain amount of anticipation, but also fear, concern, things like that. So market gaps bring out a lot of emotions in a lot of traders, but they're a huge opportunity. So opportunity and risk can go hand in hand. It's how you mitigate it, how you're prepared for it, what your responses are going to be. So does the gap type matter? Does the gap type matter as a trader? Does it matter?
I mean, it shouldn't, but oh man, you mean a gap down versus a gap up? Is that what you're?
No, but the causation for the gap.
Oh yeah,
does the causation matter?
Yeah, for sure. If it's just based on order flow versus fundamental information. Yeah, I think it's different.
Well, there's two sides to that. One side is that significant gaps are an opportunity across the board. Okay, that the trader can't sort of ignore has to, prepare, and there's lots of opportunity. Then the other part is, depending on the causation, there are certain securities and even ETFs that are going to respond differently, right? So that's where understanding what's causing a gap and, responding better. So for example, today you could have bought something at a discount that really has inflation related concerns, like a company that's not able to pass on that inflation to the consumer, that's really stuck, that's really trapped. And that stock's going to gap down, but it's not necessarily going to bounce after that. Where you might have another company that, hey, it's no problem, our margins are going to still be healthy. In fact, inflation is good for us. This is our environment. So causation can matter, but across the board, just participating in gaps correctly can really be important. So related to our pairs discussion yesterday, before I get into the other thing, so this is Exxon and XLE. Now this area here in yellow is the pre-market session. And when you have markets that are, factoring in a lot of stuff, there can be some really great anomalies in relationship-based trading. If it's safe to get on the anomaly, because the bid and ask line up properly, there's enough liquidity, there's enough volume trading pre-market, then it can be a great opportunity to get that on. So as we pull this back, we can see that, in the pre-markets, there is often some opportunity, but today was greater related to that. Okay, and these two symbols, Exxon and of course XLE, had enough participation that there was some opportunity, and these are outsized returns if you can lock the spread on relative to what it's been doing since. So early bird gets the worm on these type of things. So that pre-market opportunity, when it's there, when it's available, don't force it. Don't try to make something happen. The better you get at sort of, enveloping and fishing for liquidity and things like that, and having the ability to put one side on and not quite get the other side on and manage that, well, that comes with time. You're not going to get that right away. So always think about the risks that are in the pre-market. They are greater than during the day session, but the opportunity can be there too. Just example, sometimes traders that I've worked with, and even myself over the years, we've been able to put a pair on pre-market and take it off pre-market and have much better performance than anything that could have occurred during the day, right? So this, now it's stable, and that opportunity is subsided substantially. That doesn't mean you can't get this kind of a drift like we did yesterday, where
I just want to alert our traders and investors out there that we are coming up on the bottom of yesterday's range. So if you're so inclined to be a gap trader, we have filled the gap right now from yesterday's range, and we are still ripping.
So thank you for that report. So anyway, just wanted to point that out. We were talking about pairs yesterday, and there's opportunity with these type of days. Now, let's look at, so on the stock odds, we're producing a number of different lists, S&P 500. Another one that we're producing is the Russell 2000. And so these are the symbols that were selected by the algo for today. So again, this was produced yesterday for today, and this is purely within the Russell 2000. These are the symbols, the sector that they're in, and the expected move for the day, and their open to close odds. And a hedge could be, you could get specific by getting into ETF hedges, sector, as well as industry. Some of the sector is more related to the S&P 500 to 1500, but another choice is just IWM, which covers. But again, it can be performing kind of funny sometimes compared to the stocks you might be in, just because it's market cap weighted and things like that. So depends what stocks are in the vogue at the moment. But anyway, that was the list. And so let's look at how it's performing now. Again, the statistics don't know what's going to happen with CPI numbers today, right? There's no knowledge of that. There's no knowledge that the market will be gapping. But the list is say the top 20 that have come up from the Russell 2000. So 20 out of 2000. And actually the universe is a bit smaller because you're going to take away some of the stocks that are trading under $5 and things that have no volume and all that. So your universe is much smaller than 2000. But nonetheless, let's see what's happening here. It's this one here. So this is since the open. And again, shows the power of gaps. So here's the overnight gap right here from the close of yesterday to the open. And here's the performance since the open, right? So you can see that it's definitely skewed a positive result. Whether you even put on the IWM, even if you hedged, your performance is still much greater here on average than the IWM, right? So you have that opportunity with the gaps. And this is what I'm trying to point out, is that in one sense, because this is a very mixed group of sectors. So in one sense, the gap causation doesn't even matter when you're a volatility trader, when you're looking for just some movement, when you're looking for, anomalies, gaps. And, today we're filling the gap. It doesn't always happen. We can gap and go down. And we've had many of those this year, gap and go down. But here's the thing, allowing yourself the opportunity to, get that bounce right out of the open. Some of these things open down and immediately we're up a buck or two right away within a minute from the open today. So this is an extremely important message about how to utilize. Now, if you listen to some teaching out there, they'll say, well, you shouldn't do anything in the first half hour of the day, and you should listen. By the time you let everything get perfectly aligned and settled, not only will you probably overconfirm, overanalyze, and then ultimately be wrong, but you're going to miss the peak volatility, the peak opportunity of the day, which is in the first half hour, the first hour, even the first 2 hours.
Sometime in the first five, yesterday, using Pepsi as an example, for a good part of the day, the high and the low were established in the first 5 minutes. It hit 173.25, and then it went down to 170 in 5 minutes. So if you had your, that's some fast trading. It ended up expanding the range of the downside lower in the day, but that was because of market factors.
So we produce our odds and expectation for today. Again, no guarantee, just statistics. But out of a universe, how else are you going to pick things? Now, it takes a lot of research and knowledge to get lined up exactly which are the stocks today that would benefit most by the CPI surprise or numbers, or just change in inflation, or change in maybe what the Fed is going to have to do with interest rates. That takes a lot more. It's a lot easier just to buy a gap and put it in for the open, buy it, and then hedge if you're wrong, in the sense that, hey, whoops, it's starting to slide, or let it mature, let it try to fill the gap. Right? So almost anybody in their audience can do that. And the safest thing might be to start with, energy's performing well, and it's got a lot more volatility relative to other things today. Can, start with something consumer defensive on a day like today if you want to, kind of, don't go into some super speculative, tech stock that, is just wild anyway. That might not be the best solution for you. It might be better to go into some more boring defensive stock to play that kind of a gap. But again, on average, I just wanted to point out that this kind of performance comes on, not all the time, it comes from days like today. So in one sense, the reason that the market gaps is not as important as the opportunity to play the gap and benefit from that.
Yep.
I just wanted to keep it simple, keep it real, right? Like that kind of thing. So the opportunity on pairs is there as well, both pre-market, and sometimes you can get one stock's opening, the other one's indicated. You see that spread price could be very favorable. You get one side on, and then, when the other one opens, you lock the other side on. There's all kinds of different ways to play it. But these gap days are especially rewarding if you get in there and roll up your sleeves and play.
Okay. All right. I agree. They did fill the gap and then some. Now, I guess if you're looking for some objectives, I see some stocks are already green on the session. But if you were playing something and it didn't get above yesterday's low, let's keep an eye on those. Just playing stuff with a broad brush here. And then if your stock isn't green, maybe look for unchanged. I'm looking at Apple's slightly in the green, Tesla's in the green, so that's not object. But use your previous day's lows and your closes as targets, potential targets on the upside. Thanks for joining us here. Pre-market prep with Stock Odds. Back with you guys tomorrow. Be safe out there.